Thanks for clicking. Canada is entering into a new normal with interest rates set to be higher than they were for the past 15 years. And real estate isn't the central bank's #1 priority. This, according to Senior Deputy Governor of the Bank of Canada, Carolyn Rogers, during a speech given in Vancouver.
Nobody loves you.
The Deputy Governor's speech outlined the bank's vision for interest rates going forward, noting a number of factors are pushing up long-term rates, including high levels of government debt, rising geopolitical tensions, and increased energy costs. But the real meat of the appearance occurred during the Q&A session, where Rogers addressed the importance, or lack thereof, of real estate in the Bank of Canada's thinking, and defended Bank of Canada Governor Tiff Macklem's comments that rates would stay low until 2023. Coincidentally, or not, the hawkish comments coming from Rogers accompanied hawkish comments coming from Fed Chair Jerome Powell, who said right around the same time that if yields continue to fall, the Fed might have to revisit rate hikes. For their part, yields popped upwards immediately following the speeches.
Why?
So what I want to do today is very briefly go over Rogers' speech, then move on to the Q&A session, where the Deputy Governor discussed the real estate market, growing issues with affordability, and whether or not the Bank of Canada was liable for saying that rates would stay low until 2023. Although, as we'll see, the Bank of Canada isn't overly concerned with the real estate market, we still are, and we're eagerly awaiting the release of Canada's national real estate data for the month of October, coming out from the CREA any day now. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this speech. On to the speech. As mentioned, the Deputy Governor stressed multiple times during the speech that the bank expects interest rates to remain much higher than they have been for the past 15 years.
To stress the importance of adjusting proactively to a future where interest rates may be higher than we've seen over the last 15 years.
For her part, the Deputy Governor referenced the speech by former Deputy Governor Paul Beaudry, which we discussed on this channel, which noted the forces that had been pushing down global inflation over the past 15 or 20 years, including the high savings rates of the baby boomers, China entering the global economy, and very few places for business to invest. However, says Rogers, with those conditions changing and high levels of government debt, we could be entering into a new era of higher interest rates.
Obviously, this involves a lot of uncertainty, but it's not hard to see a world where interest rates could be persistently higher than what we've all grown accustomed to.
And while Rogers didn't address how high the new normal level of interest rates could be, if we look back 20 years, if we look back to the period pre-2008, pre-0% interest rates, we can see that the prime rate hovered between 4 and 6%, or about 1 to 3% lower than it is right now. So, though rates may eventually come down, we might get some relief from where they are right now, don't expect them to go back down to that 0% level. We could be entering into a new era of higher rates.
What about my boat?
However, given this new era of higher for longer rates, the Deputy Governor was asked if the central bank was concerned about those who are renewing their mortgages at much higher rates.
In Canada, a little below 40% of people have a mortgage. And then there's about 25% who own their home outright, and then there's a big chunk in the middle that rent. And so it is important to focus on the mortgage market, but what I would say is at the bank we focus on the entire economy and all Canadians.
I don't give a f.
And I think this is an important point going forward, that the central bank is concerned with all Canadians, not just those who hold property, especially when we're seeing prediction after prediction saying that the central bank is going to cut rates in order to save real estate. If it's not clear by now, and it should be, the Bank of Canada's #1 concern is the rate of inflation. In fact, there is no mention of real estate whatsoever in its mandate given to it by the government. So while we're seeing prediction after prediction that the bank is going to have to cut rates to get them low enough for 2025, 2026, and the renewals that are coming up, it's not clear that the bank is going to cut rates just to save the real estate market, especially if the CPI remains elevated. Regardless, the Deputy Governor continued to stress the extent to which the Bank of Canada was not concerned with the real estate market or real estate values when she was asked if the bank was concerned about those homeowners that could lose a large portion of their equity if real estate all of a sudden became affordable.
Are you serious?
Oh yeah.
I think that affordable housing will result in a lot of our clients losing substantial wealth
in their homes, housing prices actually coming down. And I don't think that the Canadians understand that's maybe the result of that sort of progress. So I think we should be preparing our clients for that. I'd like your comments.
For her part, the Deputy Governor re-explained how monetary policy works, noting that interest rates hit asset prices almost immediately, but did reiterate that it's not really the bank's problem.
We do expect house prices will likely come off a bit more, but I think your point is to the degree that people view their wealth through the lens of their home value, that's an important thing to consider for people like you.
Oh, snap.
And finally, the Deputy Governor was asked if the Bank of Canada was liable for saying that interest rates were going to stay low for a long time.
Back in July of 2020, Tiff Macklem said rates are low and they're going to be low for a long time. Many families and businesses made financial decisions based on those comments. Is there any liability with the Bank of Canada and the comments that are made?
So, the financial planner, the wealth advisor, is asking that since, surprisingly, money printing while shutting down production led to inflation, will the Bank of Canada accept liability? For her part, the Deputy Governor recalled the extent of the economic damage at the time that the Governor made those comments, and noted that the bank did what it had to do to support the economy.
So we did, the decisions we made were to support an economy that had effectively been shut down. So we did what we did at the time. I don't think we regret making those decisions at the time.
And yeah, when the Governor made those comments, it was forward guidance. He was job owning, pushing people to spend, stimulating the economy when you can't do it with interest rates, as interest rates were already at the ELB, the effective lower bound, or 0%. If rates are at 0% and people still aren't spending, you can't go below zero, so the bank used forward guidance. The bank said rates would stay low for a long time. The Governor even said that the bank was leading on real estate to do the heavy lifting of propping up the economy, and it did. And, as the Deputy Governor pointed out, it worked.
2 years was a long time for interest rates to be at the level they were. The good news is it worked. The Canadian economy, the world economy rebounded, the Canadian economy rebounded.
The central bank is well aware of what it did, regardless of how long it takes certain industries to figure it out as well. So, we have the Deputy Governor noting that interest rates could stay higher for longer, that we could be entering into a new era of higher interest rates, higher than we've seen for the past 15 years. Also, the Deputy Governor stressed on multiple occasions that the real estate market isn't really the Bank of Canada's concern. The Bank of Canada's concern is the CPI, is Canada's inflation rate. Only 40% of Canadians have mortgages, whereas 100% of Canadians have to deal with inflation. Which makes sense, as we've talked about before on this channel, inflation is a currency killer. It's the Bank of Canada's #1 priority, besides maybe the stability of the financial system, meaning the banks, but that's a discussion for another time. So, when trying to predict where the Bank of Canada is going to land 3, 6, 12 months from now, don't look to the real estate market. We should be looking at the CPI. Where is inflation heading? As the Bank of Canada has said so many times, that will be its guidepost for when it does eventually lower interest rates. With that said, Canada's CPI for the month of October is set to be out in a couple of weeks, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.